I'm Teneale.
And I'm Kelsey, and we're financial advisors from 𝗠𝑚𝑎𝑛 Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast.
Welcome back to Wealth Experience, your podcast for all things health and wealth. Today, I'm welcoming back Corey Evans, Life Risk Advisor from Personal Risk Professionals, or PRP, who joined us on episode 29. In this episode, we're going to dive a little deeper into the realities of why life insurance plays a critical role in making sure that you and your loved ones can endure financially if the worst were to happen. Welcome back, Corey.
Thank you. Good to be here.
Always good to have you here. I think that after our last segment, it's had my head thinking and about all these things when it comes to insurances. Even my own personal cover, I'm going, might be time to be reviewing that again. It has been a little hot minute, so might need to get back in there and pay attention to it again.
For sure.
Yeah. So today, did you want to talk to us a little bit about when we're talking about life insurance in general, what are some of the biggest myths or misconceptions that you come across?
Probably the two biggest ones would be referencing what we discussed last time is, I've got my cover in super. It's sorted.
Yeah, it's sorted out.
And a lot of the time that we know that you may have some cover there, but it'll be grossly underinsured. So that's a really big myth once we actually walk people through that education piece and say, look, these are the numbers we pulled together based on what you've told us. This is the amount of cover you need. And their cover in super could be 3 or 4 times less in comparison to what they need. So, and then you dive down into the definitions of what they actually need based on what they're doing, and then it becomes pretty important at that point in time. It highlights that big area.
Yeah.
The other area that is a myth for a lot of people is insurers don't pay claims. One insurer alone last financial year paid $3.5 billion in claims.
Wow.
That's just one insurer. So that was just over 40 or 45,000 policyholders, and that was $3.5 billion over 40,000.
There's a reason why premiums get more expensive, right? That's they got to pay out claims.
Yeah, there's also there's kind of like a snowball effect around premiums in terms of there's obviously the period during COVID, the insurers had a low investment returns, legislative changes to the products. So the insurers were made to essentially reprice a lot of their products to deal with profitability issues, claim statistics. So and a lot of people just who have been through the process with us get their renewal notice and see the premium increase, and then it's just having a discussion about, okay, well, is this policy still important to you, say from an income protection perspective? The benefits, are these still important because they no longer exist? And how can we make this work to change the benefits periods, change the waiting periods, change the sum insured, etc., to make sure the premium is still manageable before you just go and cut it all, because that's obviously the worst case scenario, because you end up with no cover at all, and if something happens, it has a pretty big financial impact.
Absolutely, yeah. It's definitely important to be keeping an eye on those things when you do see the renewals coming in, and like I say, it's a good opportunity to get that reviewed. Today we're going to hone in a little bit about the purpose of life insurance, specifically death cover and terminal illness cover. So we're getting into the real hard to talk about topics a little today, but do you want to talk a little to the difference between the two types of cover?
Yeah, so life cover is generally the main policy or protection, and then the terminal illness is, for the most part, on a retail policy perspective, and those in super, is the terminal illness is an inbuilt definition that essentially releases your life cover payment before you actually pass away. So obviously life cover is something happens to you and you unexpectedly pass away, the claim gets processed. But if you're diagnosed with a terminal illness, it's essentially an early payment or an acknowledgement that you are unfortunately going to pass away, and we're not going to wait until that occurs before we pay out your sum insured. Depending on the policy you've got and the product, it's either less than 12 months to live or less than 24 months to live.
Yeah,
and that needs to be signed off generally by 2 doctors to say that, yes, you are terminal and you are going to pass away. And it just allows you to sort things out with your family financially and not leave them in a position where they're sorting out that kind of scenario after the fact.
Yeah, absolutely. And, as I say, insurance is not an area that's very easy for many of us to talk about. It can be daunting to think about the reality that we all face, which is ultimately that, death is an inevitability. But there's some very real reasons why thinking about how you can protect your loved ones after your passing, and why that's a topic that we should be putting on the table and we should be addressing. This year, one of the pleasures that I get to have working in financial advice, and that you get to have working in the in risk insurance, is that we spend a lot of our clients' lifetimes together with them, right? And we get to experience that journey. Unfortunately, that means that ultimately we're going to be around when we lose some of our clients too. So this year I've personally lost 2 of my beautiful clients that were actually quite young, and sadly 2 terminal illnesses. So I thought maybe I'd share a little bit about the story of one of those clients with our listeners today. As I say, it's hard for me even talking about it now, because they touch you so deeply, but this is the power that terminal illness insurance can have for client situations. In that, one of my clients that passed, he did have terminal illness benefits in place that we had managed to keep maintained. So there was a couple of different policies there, and effectively all of those did pay out, as you say, because he'd been diagnosed, and we got the sign off there, and the payments came out. And what it enabled them to do was for him to let me know, well, I'd like my partner to be supported for the rest of her life. So we were able to put together a financial plan that showed, well, with the proceeds from the terminal illness payment, we've now got a plan in place that you know that your spouse that you're leaving behind is going to be okay. They're not going to be out on the streets, and they're not going to have to return to a working situation. They're going to be looked after, and that's incredibly powerful when they're able to see that and brought tears to his eyes, and they kind of go, I feel like I'm comfortable in that knowledge as well too. So, those are powerful situations that you go through where you can see the impact to a person's life. And when it comes to terminal illness cover, like you say, it allows them to be able to get all the ducks in a row, so that inevitably when that time comes around too, the spouse that's remaining, or the kids, or the family around, have that one less thing that they have to deal with as well, and they can go through the process of grieving their loved one. So, when it comes to terminal illness cover, Corey, is there any difference in terms of a comprehensive or a personally held cover, or, as you say, those super held covers? Is there a difference?
Generally, with the terms and conditions of the policies, whether it's in super or held personally, not really. Life cover is probably the most vanilla and black and white of the lot.
Lucky I like vanilla ice cream. That's good.
That's it. Yeah, so it's quite easy to deal with from from that perspective. Whether it's in a retail policy or within your super fund, for the most part they're on par. Where the differences can occur is sometimes with the terminal illness benefit. So some policies will generally inside your super funds may have the benefit as less than 12 months to live. Most of the retail policies are less than 24 months to live. Other than that, there's not a huge difference. Where the difference lies is on the ownership structure. So whether it's held personally or held in your super fund. And why that's important is there's different tax consequences from the super perspective. So anytime you deal with money out of super, the insurers have to abide by super legislation, as opposed to if it's a direct policy held with you personally in the insurer, it's essentially game on. They're not bound by super legislation. So where that becomes important is if people have, accidentally not updated their beneficiary. It might be to an ex-spouse and something's happened. It might be directed through to the kids where it should be the spouse or vice versa. So, or if it's paid to a non-tax dependent. So maybe it was left to the children, and the children were under the age of 18, and 10 years has passed and they're now out of home and they're adults. If it's paid to them directly, there'll be tax paid on that.
Yeah.
Whereas if it's to your spouse, for example, who's a tax dependent under the 𝐴𝑠 Regulation Act, there'll be no tax paid on it.
Absolutely. And I assume that there's just one less person involved as well too. If you had a comprehensive policy, like you say, you're dealing with the insurer, they pay direct to you. If you got that through a super fund or the likes, then there's one more party involved there.
Yeah, and a lot of the time we see life cover held inside superannuation because you can pay it with it's essentially tax. It's tax effective both on the premiums and on the way out too, as long as it's left to a spouse. Where things can get.
And what do you, sorry Corey, what do you mean when you say it's tax effective on the premiums in the super?
So you can essentially pay it with pre-tax dollars, which is quite handy. I mean, you can still pay it if you have the policy in your personal name and you pay the premium personally. You can still count it as an SG contribution, so it goes towards your concessional cap, which is now $30,000 a year. So if your employer is contributing, say $15,000, and your premium is $2,000, you'll claim the additional $2,000 as a tax deduction at 15%.
Yeah, okay.
So
there's still options.
So there's still an option. Yeah. So you can still do that. And for some people, they want to avoid super altogether. They say, look, I want to use my super purely as an investment vehicle. I don't want to have any premiums at all funded out of it, and I want to pay for it personally. And if cash flow permits, it's perfectly fine.
And one thing I do like when we're considering whether super is an option or not is that portability of your super fund becomes important to consider it too, because if you've got insurance inside super, depending on who it's owned by and how it's structured or whatnot, sometimes that can limit your ability to have choice with your super, because you go, well, maybe I don't want to be with this super fund any longer, but I've got this insurance that's stuck there now, which I need to keep a balance there. So
Correct,
creates less opportunity for you to actually be able to review what's the best fund for my needs.
Yeah, and a lot of people will, unfortunately, but it needs to occur for their insurances, will need to retain certain super funds because it's housing insurance cover that they either can't get elsewhere or would get on loadings or exclusions, like we mentioned last time. So it's in their best interest from an insurance perspective to retain that fund and keep a small balance in there to keep the insurance cover ticking over each year, essentially.
Yeah, a bit of admin there, but gives it option of both ways. And last time around we did speak a little bit about self-managed super funds, and you were mentioning, on the TPD side, own occupation and some of the risks there. But self-managed super in general, it's gained a lot more popularity in recent years. So when it comes to insurance payouts received to self-managed super funds, so on the life insurance side of things, are there any considerations for anybody that owns a self-managed super fund? Things like multiple intergenerational members in the fund. Does it have an impact on them? What can you tell us about that area?
So I guess the first thing is if you're establishing a self-managed super fund, what a lot of people don't know is as a part of the as part of the investment strategy for the fund, as a trustee, you've got an obligation to consider insurance cover, which a lot of people don't know. A lot of accountants aren't picking up on that. So it doesn't mean you necessarily have to have the cover. It just needs to be documented that as part of the investment strategy, you've considered protecting the trustees and the beneficiaries of the fund.
And then further to that you've actually reviewed it each year.
Yes.
So that's a part that we often see is overlooked.
Yeah. And I mean, an SMSF is good from that perspective because it provides a bit of flexibility because it's obviously your own super fund. And what I mean by that is in terms of claim proceeds. So generally speaking, if you have policy held within your industry or the insurer's super fund, payments from a life cover perspective are paid into the fund and then released to the beneficiary. But let's say you have two spouses that have an SMSF and one of the spouses die and the funds get paid into the SMSF, they can be retained in the SMSF until such time that you can draw down as a pension income stream and the like. So it gives the remaining beneficiary or trustee a bit of flexibility about their own personal situation around how they deploy that capital.
Yeah.
If they don't need to, then it can sit there and it can be used later on as they need. So it's quite good from that perspective. One thing to consider though is obviously the beneficiary nominations under the fund, making sure that the structure of the cover is correct, making sure premiums are reviewed, stuff like that. What we generally want to do though is if money is paid into an SMSF for a client, and for any life cover claim really for that matter, is directing them back to their financial planner to essentially say, look, these funds have showed up, we need to make sure these do these jobs that we originally planned to do, or if the situation's changed, get the advice around how this money's going to be working for them long term.
Yeah, it's important as well, because we do see those cases where a successful claim, clients come in, they've had a successful claim, and the first question that the super fund asks is, do you want the money paid out of the super fund? And there's a question then about, well, what's going to be the best case? Do I want it left in the super? Do I want it all bought out? What should I actually be doing with it as well?
A lot of the time it is paid out because the money needs to be used to pay off debt or something similar. But if you're fortunate enough where the money doesn't need to be deployed at that time, you can structure your finances and get a financial plan in order to say, well, you can actually draw down this income as a pension stream over time, which is quite good. The other thing to touch on too, with regards to not so much SMSFs but industry and retail super funds, is the legislation that was introduced relatively recently, which is the Protect Your Super laws, and this is to preserve account balances from erosion of super premiums. Now, generally what they look at is if you haven't had a contribution into the fund for 16 months, you have a low account balance, they deem that as inactive, which what they'll do is they'll write out to you and say, you have cover under this fund. Unless you tell us otherwise, we're going to be cancelling your cover.
Wow.
So you've actually got to... It's not them highlighting it and saying you should look at this. It's actually them saying, we're going to action something on your behalf. You have to tell us otherwise. So we've had cases where, sole traders, for example, when they don't pay themselves super, they might have 40 grand sitting in Host Plus or CBUS or some industry fund, and they haven't contributed to the fund for a period of time, and their cover is unfortunately cancelled under that legislation. But the unintended consequences is if that person passes away or has a disability, there's no cover in that fund at all.
And this can be really important if you've got multiple funds as well, because over time, most people have multiple jobs. So if you've had industry super funds that have been opened with different employers, and that cover's just sitting there and you're not receiving any contributions to it because you're contributing to a new fund, but you actually want the insurance cover still. That can be a real risk. So that's definitely something to check into. They call it opting into your insurance.
Correct. They essentially... It should be an opt-out, not an opt-in. It should, because people generally, unless they've got someone dealing with their insurances or managing their affairs, they're typically people will see the form and put it to the side and forget about it. And the unintentional consequence is people just lose their cover. And the big thing with insurance is it's never a risk until it is. If that cover is cancelled, and they never need to claim on it, non-issue. But that's the nature of insurance, is you don't know. So if it becomes a risk, the effects are catastrophic.
Absolutely.
Which we've had that case before. Unfortunately, we had a client who died overseas, and his account got wound up in the Protect Your Super legislation.
Oh wow.
And this proves the importance of having an advocate in this area, because we managed to get his claim approved. And if his spouse and family was dealing with the insurer themselves on this, it would have been a flat no, because he didn't respond to opting into his cover. But it was a really good outcome that we got for that family. We had the cover paid even though the cover was cancelled.
Oh wow, that is a much better outcome.
Yeah.
Oh, holy. And so when you're dealing with life insurance and you're thinking about what its purpose is really for, it can help to provide for things like equalising or increasing estate positions as well, right? So if you did have somebody that passed away and they wanted to, equalise how much is actually paid to their beneficiaries, that's something that's an option.
Yeah. So we see this typically as well for a lot of rural and farming families, where you might have a situation where one of the children stays on the farm to work, and the other one goes away to boarding school and goes to a major city to work, and you've got a situation where they want to leave the farm or assets to the child that stays, or children that stays on the farm. But how do they equal out the estate? Because that's all their assets that are going to be left. They don't generally want to leave it to them equally, because one's been contributing to the farm for X amount of years before someone passes away or gets hands down. So insurance can be used as a mechanism to equal that estate out, to kind of say, well, someone's getting this asset, and in exchange you're not going to get the asset, but you're going to get a life insurance policy to the value of that. So it helps equal that out. It's also with blended families as well. So you might have a situation where you want to provide for children from another relationship or a spouse from another relationship. That's actually not uncommon, that people still want to look after their ex-spouse. You can use superannuation balance or life insurance proceeds as what we call a non-estate asset. So if there's a direct binding nomination on the life insurance cover or the super balance, then it completely bypasses someone's will, so they become non-estate assets. So you could have your wills in place to deal with, beneficiaries getting your assets from your estate and through the will, and there might be a super balance or there might be a life insurance cover that's direct going to someone else in exchange for that.
Yeah.
So,
And that's also particularly helpful, I assume, if you are in a situation where you think that there's possibility for contestation of an estate as well, you'd like to provide for somebody specifically and don't want that to be caught up in the wills process and be at risk as such.
Yeah. And the type of nomination it's a good point because it completely bypasses the will, so it will go to that nominated beneficiary. But the type of nomination is also important because you can have a binding or non-binding nomination. So binding means that the trustee of that super fund, when that person passes away and the funds are available to be paid, they have no discretion. They are to pay the funds to that nominated beneficiary. Non-binding essentially gives the trustee some discretion to say, well, based on the situation, there's actually other people that need to be cared for, not just the named beneficiary. So they could pay all or some of the proceeds to another person. So generally, like we want to do, we don't want to give the trustee discretion around those scenarios. We want to make them binding so they're being paid directly to who their intended beneficiaries are.
And that's a really good point. So for our listeners, if they're taking a bit of a look at their beneficiary nominations on super, a binding, you sit here and think, well, why would I want a non-binding nomination? And it might not be that you wanted it. It might be that it was forced upon you because you had a binding nomination previously, but many of the funds actually expire every 3 years, those binding nominations, don't they?
Yeah, correct. So to make things more difficult, you can get a binding non-lapsing or a non-binding non-lapsing. So why we typically see a non-binding nomination is because you can do that online. You can log into your super funds portal and put in the beneficiary details and click save. As soon as you make a binding nomination, you have to complete a form. You have to provide a wet signature. You have to physically print out a form, have the nomination listed, and then have 2 witnesses sign off. So for that security of that nomination, you have to do a little bit more work, which generally is why people will have a non-binding, because they'll just do it online.
Yeah, it's a bit of a trick to look out for.
Yeah, for sure.
Okay, and so then is there anything that we need to be aware of when it comes to disclosing your health information when you're considering life insurance? Because you've spoken a bit about those contracts that you enter into and the medical underwriting. Anything in that space that our listeners should think about when they're providing those disclosures on their health information? Yep.
So from a health disclosure perspective, you're expected to provide information that a reasonable person should know. So, a lot of people, if they're getting cover for the first time and they're in their early 50s, they go, I don't know how I can remember stuff from my 20s. And you've got to provide information that you'd be reasonably expected to remember. So if you had a shoulder reconstruction 3 years ago, a reasonable person should remember that. I
might want to blank it out. I've had 2 knee reconstructions that I want to remember, of course.
Yes. I was going to say knee reconstruction, but I changed to shoulder.
It was too close, huh?
Yeah, it was probably a bit raw. But, so if you broke your pinky finger when you were 17 and you're now 50 and you forgot to disclose that information and you're applying for life cover, TPD, trauma income protection, forgetting that information wouldn't have a detrimental impact on how they assess your application. If it was a condition that would have a real impact on how they assess your application, i.e. they would be proposing a loading or exclusion based on that, then it's important you disclose that.
Yeah.
But if it's that important that they would exclude or load, then you probably should remember it from 17 years ago. Like a big one for me, that's from my personal medical history, it's not a problem for me, but I've had it forever, is I've got a small hole in my heart. So I should remember to disclose that even when I'm 50, because, I get scans used to be every 2 years, but every 5 years now.
Yeah.
So not an issue for me, but it needs to be disclosed because obviously cardiovascular related, it's heart related, that's pretty key for the insurer to know.
Yeah.
So it's what you're reasonably expected to know. And look, you can also, some clients will go through their Medicare history and see what they've claimed.
And that's probably important when we're thinking about disclosures too, right, is that information is readily available in this day and age. So there's absolutely no point trying to forcefully forget something,
No.
and not disclose something, because ultimately those records, it's in your record there.
Yeah, correct. And if you go to make a claim, the insurer will see those records. So, and if you're fraudulent with withholding that information, then the insurers can legally decline your claim. And if the information you withheld was so severe that it would have impacted how they assess your cover, they can retrospectively apply loadings or exclusions. And if the condition or illness or injury was so bad that they would have declined your application at that time when you applied, they can cancel your cover from inception. So it's important that you're...
And then you've paid all these premiums for no reason, or what happens there?
They generally refund the premiums.
Yeah, okay. Well, that's one positive, I guess.
You're back at square one, essentially.
Yeah. And no other insurer is going to want to look at you, I would imagine.
Yeah, it'd be tough at that point to get them on board. But, if you're in that position, it's probably because you're uninsurable anyway.
Yeah.
So,
yeah.
So it's just making sure what we don't want is the really good aspect of retail cover is you're medically assessed at application time. You know what you're covered for and you know what you're not covered for. We don't want to have situations at claim time where things are popping up and there's questions about whether you're going to get a claim paid.
Yeah.
That's not what we want at claim time. We want to have certainty that if something occurs, you're going to have the funds show up.
Definitely.
When and how you need them.
Yeah. So understanding what your medical history looks like and being prepared to talk that through and to disclose that, I think is the key for our listeners.
Yep.
And sometimes life insurance, there might be other items that come along with life insurance. So we've been talking a lot today specifically about life insurance, but I've seen situations, Corey, and you can probably explain this a lot better than I can, where it makes I think they call it rider cover cheaper.
Yeah, correct.
Can you explain that?
So what we generally see, you can bundle your cover together. So you can structure your cover many different ways. This is the importance of having someone kind of work that through with you, is you can have what we call standalone benefits. So these are benefits that stand by themselves. They don't have an impact on any other cover. So, for example, you could have $1 million of life cover, $1 million of TPD, and say $200,000 of trauma. If they're all standalone benefits, the insurer is technically on risk for $2.2 million. Now, if you bundle the cover together, so you have life as the main benefit, you have TPD and trauma as a rider, so it's linked to life cover, the insurer is only on risk there for essentially $1 million because you've bundled it all together.
Yeah.
If you have a trauma claim, it reduces the TPD and life cover. If you have a TPD claim, it reduces the other benefits. I
see, yeah.
So it's cheaper from that aspect because the insurer is on risk for a lower amount because all when you bundle them, they have an impact on when you claim the other covers. Now, what we want to do is if we bundle it together, that's a really popular option for a lot of people because it's cheaper and it still allows you to get all the cover, but we want to make sure we've got the additional options built in, like your reinstatement options or buyback options, which essentially means if you have a TPD claim and you get paid your $1 million, your life cover will reduce to zero. Now, that's important to know because some people might say, look, I don't want to reduce my life cover to zero, and that's where you might have to do standalone benefits. But what you can do after 12 months is essentially buy back the life cover. So you get paid your $1 million and you end up with your $1 million of life cover 12 months down the line.
Yeah, okay. And so if you've had a trauma-related event and you've had a claim on that basis, you can probably see the benefit of holding trauma insurance again then, can't you?
Yeah, and that's really important. What we really want to do, like the optional benefits for trauma reinstatement or TPD buyback, the technical terms, is it allows you to get that cover back 12 months after a claim. And I've never had a client go, I don't want the cover back. They're always asking me, when can I want to reinstate it, because they've seen the value in it.
Of course.
And the additional options, those options are not very expensive. So you'd almost be mad not to include it, to at least get that privilege of having the cover back. Obviously, when you get the cover back, the claimed event is excluded, which is reasonable. But anything else, if you're unfortunate enough to have another claimable event, it will respond.
Yeah, absolutely. And you talked a little bit earlier about beneficiaries as well. Is there anything particularly that listeners should be thinking about when they're determining who their beneficiary should be on their life insurance policy, or can they just nominate anyone?
It is important. It's important for a number of reasons. Obviously, the big one, like we've discussed a fair bit, is tax. Tax on proceed payments, depending on whether it's to a tax dependent, so a spouse or children.
And that's where it's super owned, yeah.
Correct, yeah. Whenever you have a cover, when you have policies outside of super, the tax is non-existent. So you could have, if you wanted to leave proceeds to your brother or sister or someone, then you would generally want to do that outside super, because there's no tax paid on it. It's you miss out on the tax deduction for the premium, but you don't get taxed on the way out. So it's just like anything with our tax system. If you're getting the concession on the way in, you're going to get taxed on the way out. So if you're not claiming a tax deduction down the line for non-super cover, then there's no tax on the proceeds. So the other things though is really about what we're doing with people's cover, is making sure that the right amount of money is showing up to the right people at the right time. So the consideration around beneficiaries is, generally speaking, 99.99% of the time, people are leaving their life cover to their other half. The consideration that needs to be had though is and it's not a fun discussion by all means, but if both spouses unfortunately pass away at the one go, like in a car accident, and they've got children who are 10 and 7, then how do they tax effectively get this money through to their children for their benefit? So that's where wills can become really important, because you generally want to maybe have a discretionary trust established, and someone controlling that trust on the children's behalf, paying for medical expenses or childcare costs, living arrangements and the like, and then at a certain age they'll get access to the remaining estate. Wow. So it's important, because if the surviving spouse is around, then obviously they can continue, albeit without the other half, they can continue with the income and they can support the children. But if both parents are gone, how does that money being dealt with tax effectively for the children? So you want to make sure that you've got someone that you trust that's doing that job. Yeah, okay. Well, there's a lot to think about then. It's not just set up a policy and forget about it, is it? It's about making sure that you've thought through, what if something happens to me, what needs to happen for the family, how do they get funds? And that's a big one too. Not only controlling the funds for the children, but who's going to be their guardians, who's going to look after them. So, it's pretty key jobs that a lot of people, unfortunately, they don't really want to think about. It's a pretty tough topic to deal with, but it's a very true and real one at the same time that you need to be prepared for. Definitely. Well, we know it's not an easy area to talk about, but the positive is that it is an easy area to address. So life and terminal illness insurance can be typically, it's easier than some other covers to establish. It can be relatively inexpensive. And so for our listeners, we hope that you've taken away some good food for thought around your own life insurance needs. And if you have any specific needs, as I mentioned earlier, feel free to reach out to Corey and the team at PRP directly. Thank you so much, Corey. We've really appreciated having you again today. Awesome. Thanks for having me. Appreciate it. Come back up again soon. Will do. Alternatively, for our listeners, if you have any questions that you would like answered on our podcast, please send in a comment. Don't forget to follow the podcast and share our content so that we can bring you more like this in the future. That wraps up another Wealth Experience podcast. The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.